Welcome to the Alt Asset Allocation Podcast, exploring alternative investment opportunities available to the everyday investor. Here's your host, Ben Lakoff.
Hello and welcome to the Alt Asset Allocation Podcast. Today's interview is with George Goncalves. The world is weird right now, and George is an expert on macro outlook. So we start this episode with a recap of the Fed action as a result of the coronavirus. Then we quickly cover all things macro, so US dollars, including shadow banking and the EuroDollar, gold, and then obviously bonds. We talk about the current state of these markets and where they could go in the future. So I get a lot of listeners on this podcast, but I really only have like 30 reviews. If you're listening to this and you're getting some value, please take a second, stop, and drop a review if you're getting any sort of value. I really appreciate it, and it really helps. If you're watching this on YouTube, hello. Please hit subscribe. That also helps, and I really appreciate it. There you go. Enjoy this conversation with George Goncalves. George, welcome to the show. Excited to have you on today.
I'm glad to be here. Thanks for having me, Ben.
Absolutely. Hey, I've really enjoyed reading a lot of your tweets and a lot of the content that you have on your blog. But to kick this thing off, let's start off with a little bit of your background, who you are, where you are.
Sure. So I'm, I guess, what you would consider a global macro type strategist that's really, it looks like, it's becoming more of an art form than necessarily a sort of a skill set per se, but especially in the world that we live in, everything's digital and we can kind of put algorithms on everything. But I'm a classically trained fundamental economics, global macro, looking at cross-market relationships, with all through the lens of bond strategy, ultimately bringing it back to like the basics of global macro, which is both FX and the fixed income securities. I've been doing this for over 20 years, primarily on Wall Street through various investment banks where I've held positions as senior strategists as well as leads of fixed income groups on the strategy side. And in the last year or so, to really have been venturing off on my own, but partly because of the world that we went through in 2020 and COVID kind of making us all kind of work from home and having to really rethink how platforms are developed and how content is delivered. And so I've been really building out my outreach to the audience out there in FinTwit as well as more broadly on the internet, and doing these podcasts like this and videos to really with the goal and the intent of that there's, in my belief, there's a good understanding of the bond market, but it's sometimes loosely thrown around out there, and I feel like there's a lot of financial literacy that has to take place for investors to understand that really key component in their portfolio, as well as the day-to-day activity, which sometimes unless you're really in it and understand like why things are moving, the bond market can seem like a foreign territory.
Your Twitter is a treasure trove of information, so I'll definitely link that in the bondstrategist.com. So there's a lot going on. I wanted to start off today talking about central bank action. This is being recorded January 2021. The numbers are just overwhelming for most folks, myself included, and there's just a lot going on. Let's start the conversation if you start with a recap of what central banks have done since the start of this coronavirus issue, and let us know, where are they now and what do they have left?
If we go back to the beginning of last year and basically this time last year in 2020, and we think about how far we've come along, we've now moved. We've always been, one could argue, since 2008, 2009. We crossed the Rubicon back then, where the central bank activism really picked up as we really got to the kind of the final stages of a financialized world that requires more and more liquidity and cheaper ways of funding, and central banks, except for the Fed, who really tried to lift off rates and get off of zero, really spent only a couple of years there above zero, and And what we found and what we have been really going through for the last decade plus is just this realization that we moved from the central bank action taking place through the price of money, which would encourage or change the behavior of investors as well as banks to expand lending, which really grows the kind of the actual dollars in the system through the private sector banking. They really got to a point where the actual rate channel stopped operating like it used to. I mean, and one would expect that as you get close to zero, or in some cases in Europe and Japan, that negative, which is a whole other story. But the reliance and the shift from rate policy to QE, which initially caught a lot of people off guard or shocked them, and there were so many gold bugs, and in many ways, I guess some of the reasons why cryptocurrency took off was really in response to this idea that the old system has to rethink and overhaul itself when there's this much debt in the system and things are not balancing out. This move towards QE really is still a legacy of this, the financial crisis, right? So if you think about that, and then you think about what a pandemic the size of coronavirus would do to a system, especially one that is dependent on cash flows to be always operational and for money to be circulating globally, not just in the US, but moving around, so that living in a just-in-time type world where payment systems are super critical to making sure that other companies get money in the door to help pay out some sort of dividend or a debt obligation, whatever the case may be. When you start locking down countries and or regions and economic activity stalls, you really create this shortage of liquidity. And considering that most of this liquidity globally still operates on the back of the dollar, it was one didn't have to really imagine much to think that the Fed would probably have to do the most of the heavy lifting. And so what the Fed did was was massive. I mean, they did over 3 trillion by the early summer period of 2020. And I think that response and that quantum and that number seems big, and it is indeed very large, but it's kind of has like taken on a life of its own, where it's now almost become like as if the narrative out there is that now that we've seen this happen before, that it's always going to be like this. Whenever there is some sort of major crisis, we're going to see just trillions upon trillions being printed or really more injected into the system. We can go into more details on how the Fed's balance sheet works if you're interested, and how that interacts with the banks and what options they have going forward. But I mean, I think there's this kind of like there was this shock and awe moment in the early part in response to making sure that the systems were liquid and operational, and the Fed really taking the lead there. That then for the months and quarters since, and the Fed's balance sheet continues to grow. Don't get me wrong, it's growing at 120 billion per month, but it pales in comparison to the speed of what we saw on an annualized basis in that end of Q1, early part of Q2 of 2020. But the narrative, which I see it all throughout FinTwit and all throughout the financial media, is that they're printing like there's no tomorrow, and that there's going to be this, massive liquidity. It's going to keep going forever, and that's going to justify, asset valuations for everything. That to me is where I start to diverge from the kind of consensus out there that suggests that central banks are just never going to stop. And I think that's going to be the real question as we sit here in the beginning of 21. Are they going to up the ante? Are they going to do even more than what they did last year? Or are they still in this kind of deceleration? And eventually, which we're hearing from some Fed speakers, that they may have to taper. And that's that. But these are all very important dynamics to understand, because one thing I have a good friend, I'm sure, Danielle DiMartino Booth, and for us, we're looking at the outlook for 21. The common theme and the overall kind of topic for the year is really starting points matter. And we're starting from a point where a lot of this information is baked in the cake, in my humble opinion.
Yeah, that makes sense. The world is drunk on cheap debt, and we need a lot of liquidity to keep this thing going. And yes, we've done massive QE, but it just seems like, this narrative that you talk about is that the Fed is running out of silver bullets. They're just going to keep inflating the balance sheet. What's your view? How do they start unwinding this, in your opinion?
So this is where I feel like and look, we'll see how the next few days, a few weeks, things work out in the first 100 days of the next administration, and how the Treasury really, at that point, which we would assume would, Janet Yellen would be confirmed as, Treasury Secretary, and at that point, it's almost like I feel like we're going to see like a baton being passed to the fiscal side. If you think about it, all throughout last year, after the CARES Act, there was a ton of money sitting at the Fed, which was Treasury's money, which was raised for a lot of different reasons. I've covered it either in reports that I've written or sporadically throughout the Twitter world. But this money sits in an account called the Treasury General Account, and for years it was really a sleepy account. No one really focused on it. No one really cared. Really up until the financial crisis, there was actually some balance of some dollars that were sitting, U.S. money, U.S. government money sitting at banks as well as at the Fed because they were kind of indifferent. But then after counterparty risks and concerns around that, as well as operational readiness, and quite frankly, I always characterize the TGA in a similar vein like the Strategic Petroleum Reserve, the SPR, where you kind of have like this national defense element to having extra liquidity, both oil or extra dollars, just in case, right? And so that started to take on a bigger meaning over the course of post financial crisis, especially during the more which now seemed like child's play compared to the sort of acrimony that we have in Washington. But if you recall, throughout the Obama administration, there was many debt ceiling impasses and fights, and even into the Trump administration as well, around just spending and trying to rein things in and have the ability to kind of slow down this debt load that was growing at a fast rate, and now it's really accelerated even further. So this having operational readiness to be able to pay your bills on time and have extra cash has been an initiative that the Treasury has put in place for the last 10 years, or last 7 or so years, and really post financial crisis. That account ballooned to over 1.5 trillion, like 1.6 or something, during the height of that one quarter when the Fed was expanding its balance sheet at the same time. And so when this was happening at the same time, it's almost like you couldn't tell what was going on. The Fed's massively buying a lot of treasuries, a lot of them legacy older treasuries that were in the system, and the on the other side of the ledger, which are on the other side where the government actually issues the debt, the Treasury was issuing a lot of short-term treasuries, mostly T-bills as they're called, and those dollars raised were then redeposited back at the Fed, because that's where the Treasury keeps its extra cash, because the U.S. government was not spending money fast enough, even during the height of the pandemic, and even through the passage of the CARES Act, money was just not leaving fast enough because it wasn't fully appropriated or the spending wasn't authorized. And then we spent, really from June until basically the end of the year, fighting over how to do another fiscal stimulus deal, which a lot of that cash should now fund the stimulus deal that was recently passed and probably can give a down payment on any subsequent stimulus packages that we may get this year as well. So I bring this up because this is very wonky, and maybe some of your audience might not fully care, but I think it's an important point, largely because those dollars were taken out of the system in a way where the Fed didn't create those reserves. The U.S. government did by borrowing from investors that, quite frankly, were panicked and moved money into short-term treasuries for defensive reasons, and most of them through the channels of money market funds. And so, money market funds, they only could buy, they have a kind of jurisdictional constraint of like what can they buy, and a lot of them bought these short-term treasuries, then that money just basically went from the money market investors straight through the Treasury onto the Fed's balance sheet. And it's just sitting there kind of inert, not doing anything. And now, as the government starts to spend that money for stimulus, it could get reintroduced right back into the economy, which would then potentially accelerate inflation, as well as it could be the echo effect of basically what we saw last year. So even if the Fed does not expand its balance sheet at a faster rate, the reserves can be growing at a speed that's much quicker than $120 billion per month. And that's where this song and dance gets very, very interesting. And this is where the Fed may at some point realize that, look, the balance sheet's reserves are going to get too big. So the reserves sit on the liability side, that they may have to slow down their QE. Otherwise, you're going to see so much extra reserves sitting in the system, and either inflate these bubbles even more, because I think we're definitely in final stages of certain bubbles in some asset classes. And so this is the challenge that they have, as they know that the economy is going to move hopefully back to more of whatever normal is going to be, but we're going to get some sort of stability with the vaccines and reopening of the economy over the next year or so. And then you have all this pent up liquidity that was already created, and it's going to get spent through the fiscal channels. And therefore, the Fed does not have to do more. Actually, in fact, it might have to actually start to peel back and taper. And that's something, sounds kind of like sacrilegious that I can say something like that, when everyone's like, no way, the Fed's never going to stop. They're going to keep printing. I think that, they realized that, they probably overdid it. They probably did too much easing. And now you have this cash injection, which may come through the government side. The Fed might have to actually just slow it down. Now, that's a lot that I just downloaded, so I'm going to take a pause there and see if you want to break it apart maybe.
Yeah, firstly, there's so many connected pieces here, and it's the culmination of many, many years of cheap debt, and coronavirus was kind of the linchpin that just we kind of used. But I mean, the average investor here just knows that the Fed is printing. I get that eventually we'll have to switch to fiscal policy. And, maybe this is enabled by things like central bank digital currencies, so they can push fiscal policy directly into your wallet and things like that. But just thinking a little bit further, like, what is the end game here? Do we have to switch to something like MMT? I mean, with debt levels this high, yeah, we can taper. Yeah, we can be a little bit more aware of cut back our spending. But ultimately, the other two options, inflate or default, seem to be the more likely scenarios. How do you see this playing out with all these moving parts?
Yeah, so I mean, look, I think anyone that comes on your show, or quite frankly, anyone in the financial content business, will tell you that we all have our kind of short-term, medium-term, and long-term projections, and our conviction levels will kind of fade as the further you go out. I think, look, it does look untenable, and we're at a point where it's, it does feel like the kind of a last mile, and especially with the debt loads that are out there. Having said that, though, I mean, there's got to be, at some point, I think what we'll probably find out in the next 4 to 8 years, and we'll see how this administration conducts itself. I mean, what they really want, I think, and I generally believe this, that they want the private sector to take up and take over again. Not this idea that we can just somehow have the government provide all forms of assistance, and that's going to lead to actual productivity and real growth, not just this nominal growth that might wash away some of this debt. That to me is definitely not the American way, regardless of where you stand. And I think, we basically, and I've been saying this since 2008. I mean, we've basically been fighting a financial war akin to like World War II, and it's really because of how the system's been designed globally. And so we worked our way out of that, and hopefully we never get to that extreme. But we worked our way out of World War II into the 50s and 60s. It's going to require, in many ways, control first and then release later. And that's why some are advocating, and I'm not completely against it myself either, that given where we are with low levels of yields, and there is some long-term investments that could be done that could enhance the overall nation's productivity around infrastructure and things like that, that will really boost overall growth in the next 10, 20 years. Because what we cannot have like a stagnant type world and hope that it's going to resolve itself and that inflation magically is going to appear. You really need to see, and this is where I think it's going to be fascinating, because of technology not really having much of a footprint. It's operates in the cloud and things like that, and the barriers are not that expensive to get in. You just have to have the intellectual capacity. On the one hand, that's obviously deflationary by nature. AI is deflationary by nature, but at the same time, there's the pendulum has swung so hard in favor of those that are the hold capital, that are really the culmination of this wealth inequality that we're seeing. The pendulum is swinging the other way, away from capital holders and more towards actual human capital and wages. Like, that's really the only saving grace, because at that point you can tax people more. Not that I'm advocating taxes, but you need to broaden out your tax base. You need to get people a chance to have part of that pie that's really been shifted over to only to one side of society. That has to kind of happen through some government measures and organically. And look, who knows when who's going to be the right person to do that, but we need to start at some point, because perpetuating this is not going to work.
Yeah, I completely agree. I think it's pretty unlikely that taxes will go anywhere but up in the kind of longer term, in my opinion. But I think that sets the stage quite nicely for where we are, and kind of lends itself into the next question, which would be midterm and longer term outlook for the US dollar.
Yeah, so look, I think these things don't happen overnight. I don't think they will, but it's a process, right? We've seen reserve currencies come and go over the last 500 years. And I think also, there's a school of thought that thinks it's this great benefit, and there is tremendous benefit by being the reserve currency. But at the same time, there is a lot of burden that's really placed on the U.S. And in many ways, sometimes the Fed has had to overstimulate because it wants to make sure that these leaky pipes that exist further out outside the U.S. somehow get their fill of liquidity too, when in fact, if there was a more globalized real-time payments system that didn't require everything to be conducted through the dollar channel, it actually might allow the Fed to have actually better monetary policy flexibility. So it could be both. There's benefits and there's pros and cons to all this. I mean, I think that the dollar will remain a key piece in whatever world that we're heading into, and it's not going to be dethroned that quickly. But we've been going through that process really since 2008, and so it's trying to manage it. And the issue is that we end up getting more and more into debt, which then compounds the problem down the road. But and not just I'm saying like these emerging market companies and corporates and countries that borrow in dollars, which they can't print the dollars, so they have to source it. I mean, it's the shadow banking system, it's the EuroDollar banking system, it's the money that's created out of thin air outside of the Fed's domain that really sometimes creates these bottlenecks and concerns that really brings the financial markets to its knees. So I think there's if done in a way where it's in proper kind of coordination, a more basket style payment system, and it could. This is where I think the great work that's being done by a number of the fintech companies, even how crypto will be part of that, and we might run on the same rails. I don't know, or maybe not. But this area of finance that's really the area of innovation it's thinking through some of these issues and trying to come up with ways where it's not about bashing the dollar or we want to get rid of the dollar. It's more about, there's got to be better ways of and more efficient ways of, money circulating globally and not have to only be in one type of currency. And I think that's definitely in the near future, and that's coming. And it does have consequences, right? Because for the last really 20, 30 years, our debts in the US have been largely financed up until like 3 or 4 years ago by foreign investors. And so they did that because of various payment shocks back when, finance was even less mature than it is now, where the Asian financial crisis, there's a number of key events over the last 20, 30 years that really shifted, the dollar as the preferred medium of exchange. And if we get to a more efficient way of conducting payment systems, then you won't need to see these big hordes of dollars sitting outside the US. And so those dollars come home to roost. They come back home to the US, back into the domain of the Fed, back into the US banking system. And in a way, you kind of regain some of your, again, flexibility and autonomy that you don't need to just have to ease because the rest of the world is suffering from some sort of reason. And the Fed has to stay ultra accommodated. But then meanwhile, it's like inflating housing prices or something, right?
Right.
So, this is where I think there's pros and cons to a better balanced, designed payment system that moves away from the dollar in a way that's constructive.
Yeah, there's a lot of innovations, especially in the crypto space, that could lend itself to helping quicken this transition. But I think before we kind of move on from this, I think it's important to, if you could explain EuroDollar and shadow banking a little bit on how the US dollar is created outside of the US and what this looks like.
Yeah. So and this goes back to just even in the US. I mean, when there's lending that's done and then it gets redeposited at another bank, those dollars were created out of thin air, and then there's a portion that's reserved, and well, now not because of some of the changes that the Fed did post coronavirus, but just standard banking 101. It's the private sector that grows the fiat in the system, and so when that's happening outside the direct purview of the Fed, and it's happening in Asia and in Europe. It primarily started in Europe. That's why they're, in London specifically, why it's called the EuroDollar system. But it's when you actually are seeing dollars created by jurisdictions outside the Fed's control, and these banks are expanding the dollars globally. Now, because this is based on a lending and debt financed architecture, there are times where either some of those loans are not money good, or there's cash flow shortfalls, and then that creates these weird bottlenecks that we get from time to time that people say, oh, there's a massive short of dollars globally overseas. It's because it wasn't created through the Fed channel, or not even created because the Fed doesn't create the dollars. They actually just create the reserves that allow for the expansion. But it's this network of banks, corporates that sit in overseas markets, and that's like the most basic. And then there's a whole level around trading that's done on top of that, and short-term interest rate trading, foreign currency exchange trading. Repo plays a role in all repo markets, and the collateral systems are really super critical to the functioning of that EuroDollar. There's been a lot of folks that have covered that in greater detail than I'm going through right now, but it's part and parcel to this dollar-based global world. I mean, it's a part of the transmission mechanism that allows the dollars to kind of circulate outside of a U.S. banking system.
And the crazy thing for me is the size of this market. I mean, we don't even know how big it is, right? Or how integral it is part of the global financial system as we know it. Isn't that right?
That's true. I mean, there's a lot of great work done by the Bank of International Settlements, BIS, in Switzerland, and they'll come out with reports like every quarter, once a year at least, that will try to estimate the size of this, overseas dollar market, non-US. And a lot of it is just kind of trying to follow the money because it has to circulate through and get a sense of the scope and how big it is. But it's really taken on a life of its own. And to think that you can stop that just because the dollar is like falling out of favor doesn't make any sense, because all that really happens is that by the dollar getting cheaper, it actually helps a lot of these emerging markets, because then it's easier to service their debt if their currency is doing better. So I think this notion that we have this behemoth out there, we don't know the full extent of it, doesn't mean it's a bad system per se. It's just what ended up being designed and created, post World War II into moving away from the gold standard. It's now just gotten so massive, and it has a lot of leaks, and it's something where you can't necessarily just pull the plug on it. You can't reset it overnight. You need to be really thoughtful and work with both, again, the financial industry, the fintech side of things, and really have a global cooperation. And at some point, where if they want to get off a dollar only standard, you need to work out a lot of these issues and have a huge long run. You cannot do it overnight. It's a 5, 10, maybe 20-year plan. It's something that has to be done in stages. In many ways, how a lot of the regulation is done and coordinated globally on the financial side, I think this is probably even more important than that. And it has to be done in a way where it's not meant to punish or reward anyone else, although there will be, on the margin, winners and losers to this, because if you're changing a system that's benefited some in ways where we can't fully quantify, if we get better architecture, more checks and balances, which things like blockchain help create, and a more stable payment system that is accountable and verifiable, that's going to probably enhance efficiencies, but also take away some that were probably benefiting from the legacy system.
That's a lot about the dollar. There's a lot going on there and a lot of connected pieces globally. And like you said, things certainly don't happen overnight. But actually, what was your kind of midterm and longer term outlook for the US dollar there?
As a value, in terms of valuation.
Yeah.
Okay. Yeah. So this is where I'm a little bit, I think, out of consensus, and maybe I'll be proven wrong this year, but it's a view that I'm taking, and it's tied to the earlier points that I made about perhaps central banks did too much already, and that now this year it's more about slowly scaling back and perhaps even tapering on the Fed's part. That and then we're shifting the baton and passing the baton to the fiscal side, that the dollar does not necessarily have to continue to weaken, that other countries are in just as bad shape or worse, and everyone's really coming out of this global pandemic at different levels, but not one area is really going to outshine the other. And so, especially on the developed market side, there might be more quicker to the punch, faster EM countries that might be able to accelerate their economies faster in a recovery. But by and large, developed markets are all in the same boat. So this idea that the dollar has to fall out of bed and really and have a crash, I think it's just the wrong trade. And everyone's and a lot of folks are in that trade. I mean, there's been a lot of shorts put in place. So medium term, meaning like the next 6 months to a year, I feel like we probably did a lot of damage on the dollar. It's due a bounce. I don't think it has to necessarily go back all the way to the highs that we saw last March, but anywhere in between makes a lot of sense. And I think that's going to then, the combination of the dollar getting a little bit stronger and this move up in rates that we're seeing, which I think still has legs, which we can discuss later, that's going to start to tighten financial conditions. And this is where it's going to be very delicate between what the Fed interprets the fiscal policy. Is it bigger than the tightening that we're going to see coming from these two other channels? And that's what's really going to calibrate monetary policy more so than them rushing to market with some new initiative, unless rates spike to like 2-3%, which I don't think so. They're not going to do anything major, and then I think this really takes them out of the equation. So And that's a big deal for a lot of investors who are thinking that they're just going to keep printing forever, and then the dollar should appreciate in that sort of backdrop.
Yeah, that makes sense. I completely agree. It's like the dollar's bad, but nearly every country, if not every country, is also bad, if not worse. Perhaps it's trust in fiat overall that's kind of declining, which leads me perhaps into the next question on just your overall thoughts on something like gold.
So gold plays a special role still, and it's been with us for thousands of years, and I don't think it's going anywhere anytime soon. The the challenge I think with gold in this environment is it's all about speed of change. And I just went through the early part of this interview podcast, I should say. It's kind of discussing that and I could be wrong, and this is just my own personal view, that perhaps we've done a lot from the policy side and to in this idea that we're going to see even more debasement and devaluing the dollar or any currency, quite frankly. If we don't see the speed pick up, so if I'm wrong and the Fed did 3 trillion last year, they're on track for a little bit over a trillion or so this year. If they go back up to 3 or 4 trillion, then they're beating last year's comps, right? So they're going faster than the speed at which they were expanding their balance sheet in 2020. I mean, it's going to take something like that to really, really motivate and push up all these other alternative forms of storage of value and safety. It's going to really require the speed and the change of all this to accelerate even more than what we saw last year. Like last year was impressive and just shocking at the same time to see how fast they can expand the monetary base and all these M1s, M2s, and everything were just growing at leaps and bounds. But typically, when that happens, the following year is like the hangover effect, where you actually see a give back because you just can't keep running at that speed forever. So if we don't get an acceleration from where we are now, I mean, I think to expect gold to rise to the numbers that some have out there, I'm not there. Having said all that, like $3,000 or $5,000 in the next whatever year or so. Having said that, I mean, I do think that what everyone's learned, at least in some manner over the last year, is that you have to have savings and you have to think about where you put that savings and how you're going to protect your overall wealth. And it's not just in equities, it's in other forms of alternative assets, which I know you do a great job in highlighting. So it does play a role. So you cannot have zero allocation. You need to have an allocation towards these other forms like gold, like cryptocurrency, because you just don't know when there might be another impulse higher. So, that's a long-winded answer of saying that, I mean, would I be buying necessarily or adding here? I mean, as a long-term investor, sure, but we have to realize that it's probably going to get bumpy over the course of 21 and that it's not going to just be a straight line. We're going to see waves of ups and downs in these alternative assets because we just don't know what their intrinsic values are over long periods of time, and unless we get an acceleration of additional liquidity, it's going to be hard to chase them higher. So I think it's something. It's an anchor in many people's portfolios that should remain, and it's something that you may want to, if that's something that you do, to dollar cost average and to add to it over the years, but relatively neutral to slightly concerned that we might see a pullback. And it's linked to my view on the dollar, because if the dollar does go up 5% or so, and if real rates were to keep going higher here in the course of the next 3 to 6 months, that's going to introduce further weakness into these precious metals.
Yeah, that makes a lot of sense. And we're obviously big fans of alternative assets here, but it's all relative, right? They can be great stores of value for thousands of years, but if everything's screaming higher and real rates are rising, then yeah, it's tough to outperform in that backdrop. Transitioning from gold, I always like to go right to the digital equivalent of gold, perhaps. But coming from your background as a Wall Street insider, I'd be curious your thoughts on something like Bitcoin and cryptocurrencies in general?
Yeah, so I mean, I've been studying it over the last year or so, really trying to understand and drawing in parallel the old system of payments, which we went over briefly, and trying to understand how this, these currencies as well as the technology around it could, really benefit and eventually replace some of the architecture that we have out there. So I'm very open to this new frontier that's been opened up on the crypto side, and I do think more and more investors in traditional finance and in institutional side, we're hearing more and more interest picking up as each day goes by. So I'm a fan in the sense that I like innovation, and I think it's fascinating to do this, this kind of contrast between the old system and the new system. What kind of trades would work, how people trade this thing to begin with. To me, it feels like still like a commodity in many regards, and with the way the momentum really and just the idea of scarcity or the idea of like what's out there and the availability. But at the same time, I'm just wondering, how early are we in this process, and who's going to be the ultimate winner, or will there be like just multiple winners? I mean, but not all coins will, or not all forms of cryptocurrencies will remain. Not all stable coins will be successful. So I think it's definitely early days. It's something that I'm spending more time trying to again analyze through the traditional finance lens, and then juxtaposing it to what may be coming down the road, because I think there's going to be tremendous benefits around, again, this whole just-in-time cash flow exchanging, settlement issues, enhancing just the efficiencies of transactions, the avoidance of mistakes, and all of these, which end up being a tax or an inflation on the banking side, which hopefully can go away. And things, the advent and all the things that we're learning from crypto and how it's being implemented should one day have a better system that's purely more digital, and really start to kind of compete with this old world.
Yeah, definitely. And it's reached this inflection point, I think, where it's too big to ignore. It's getting too big to perhaps not have a view on it, not own any at this point. It's certainly getting very exciting, but at risk of going down. Yeah, go ahead.
Yeah. No, I'm sorry, I'm cutting you off, but it's like everything else. We've learned that diversification is something that's important, right? I mean, it's part of like the whole idea of asset allocation. You have to understand that not all of them are going to be winners, but this idea that you can't dismiss it either. It's now a real thing.
Absolutely. I'd be remiss if I didn't ask you, I mean, a bit more. Your Twitter handle and website is The Bond Strategist. And, I save these things for the very last, right? But I think everything we've talked to kind of feeds into your decision-making with the bond market. I see headlines like the end of the 40-year bond bull market, or the 60-40 portfolio with the 40% being bonds is dead. You talked about gold serving as a bellwether in the asset allocation. Like, what are your views on bonds in general? And then perhaps we'll jump in a little bit more deep.
So it's no surprise that when bonds became super volatile last year, and that then also infected the credit markets, which are also corporate bonds. So if you start from the foundation, which is government bonds and repo and overall liquidity that the Fed provides, and you work your way up the pyramid. The bond market is the building blocks of the current financial system. So you cannot think that they're going to go away. If anything, they're just too big, right? So it's why the Fed's always super laser focused on making sure that's operating smoothly and things are going well. So the bond market, it's going to be around. So it's going to play a role in people's portfolios. The question is how big of a role it's going to play, whose portfolios are they're going to be in, and at some point, are we able to eventually get back to really rewarding investors and savers with a more proper interest rate that's in line with just the idea of everyone's time is worth something, everyone's capital is worth something. It's not worth zero or negative. We shouldn't be penalizing capital holders either. So I think that what investors are, especially for those that don't have to manage to benchmarks and that don't need to, they're not mandated by regulation or by law to be invested in certain sectors. I mean, bonds at this point do not offer that much value, but they offer a little bit more value than they did in the summer of last year, especially when rates were close to 50 basis points on the 10-year. I think there's going to be a limitation on how high rates can go as we are, as I described earlier, we're in this long-term game plan of where we need to transition away from just capital getting all the rewards of the system to more wage earners. That the bond market's going to be like the middle ground for that. So I think having really barbelled approach to the bond market in your portfolios, especially this 60-40 is a notion that's put out there, linked to age groups and things like that, and demographics does suggest you should shift more into bonds. But then when they're earning next to nothing, it really, we're seeing this whole reach for yield, and in many ways bond surrogates and substitutes, which sometimes are much worse than the bonds because they can actually lose money, not just not pay you interest. So I think people have to be prudent. They still need to have a decent portion of fixed income, especially considering all other asset classes are overvalued too. So this is like a game of hot potato, like which one's more overvalued than the next. If we're lucky and rates do get up to like 150 on the 10-year, and we're stabilizing and the economy is doing okay, I think there could very well be an environment where the economy does okay, but risk assets do not, because they again pulled forward too much of the future growth expectations. And so we'll start to see a healing of the economy and reopening, but yet assets won't be reacting to that because they basically pulled it forward and then some. That the bond market might not be a bad place to hang out to figure things out. So I would not completely shun fixed income at this juncture. I would just be much more barbelled, have a little bit of extra cash so that you can at times opportunistically put into higher yielding fixed income type securities as rates start to continue to rise a little bit higher, and then be aware that this can all turn on its head if there's any sort of new variable that we're not thinking about. So I'm generally I would be considered bearish bond market. I've been basically bearish since August, September of last year when rates got to the lows, and it was too pessimistic. Everyone was expecting the Fed to keep rates at that level. They haven't really stepped up the rhetoric yet. Some of them are talking about taper. I think that in order to do what would be one of the remaining tools from the Fed is this yield curve control. I think that we would have to get rates higher and feel like as if they're going to get away from us or run away from what the Fed can potentially do. Then that's when they would step in and do yield curve control. So, I think that they're allowing the system to open up and breathe and pick up some yield. This is good for pensions and for those that are in retirement. So I think that's what we're at right now as we get into the summer. Beyond that, I really don't know. It all depends on how well the vaccine rollout really is, and if there's no other mutations, if the economy is able to really properly open up, and if we don't just see a reaction to a financial market that cannot keep going up at the speed that it was going up, if that wealth effect slows things down in the second half into early 22. So I think bonds are giving. The Fed and the bonds are giving you a little bit of a window here to be cautious, but also to be opportunistic and really learn how to barbell, take some cash, reinvest when rates are going up, and do that. I think that's where bonds are right now. Long term, it's one of the reasons why they cannot let rates go up too much.
Yeah, that makes a lot of sense. Things certainly are changing in the way that bonds are viewed in a portfolio, that's for sure. Earlier in the conversation, you mentioned that we might perhaps be in the final stages of bubbles in certain asset classes. What were you referring to?
I mean, primarily the equity space, although it's not my area. And when we're looking at things through a global macro lens and you go back and look at where valuations are, and then you try to think about what that means also for my specialty in my area, which is the bond market. if there is a sort of equity correction in the near future, it's going to really limit this, this view that rates can actually go up, because at some point people would just flip it and then start buying bonds and drill rates lower. So, I mean, I watch it closely, and everything that I'm looking at, it's hard not to walk away unless you subscribe to this idea that, hey, it's only justifiable because rates are low. But then I'm like, okay, but what if rates are higher? And then it's not justifiable, is it? Like, so this idea that, we have super stretched valuations on every single metric that you can look at over the long haul. And it's really, I would say, the high flyers, which we all know who they are. And these are valuations that will look back and say, what were we thinking? But in the heat of the moment, as we are today and where we've been for the last 6 months, there's just been a lot of chasing of performance. And quite frankly, this buildup of dollars also in the banking system with, fiscal transfers, moratoriums, and just people just having more dollars at their disposal. A lot of it had to have gone into the equity markets. I mean, there's no other way to think about it. And so as we move away and get back to some sort of normalcy, and people start to go back to their normal livelihoods, maybe they day trade less. I don't know. Maybe they will actually, see, they have to start using their money to pay back bills or whatever the case may be, instead of just, going into equities. And if you have to start monetizing those equities to make payments for either leverage or margin debt. So I feel like that's really the pinnacle of it. It could very well end up being like as a rotation within, which hasn't really happened for the last 10 years between growth and value. I mean, value has had a nice run in the last 2.5 months post-election, but there's probably more gains in that, in store in that area. But people have to realize that it's, value stocks are still stocks, and so if we were to see some sort of risk reduction or a just kind of a correction or even a bear market again, the value probably comes down with it too. It just probably doesn't come down as much. So I think that's where I see the greatest bubbles. And then some of the I'm not an expert on the crypto space, but there is this this fervor that happens every so often. I think we just went through one. Maybe we're still in it, and there's more upside still. I don't know, but I think even within the crypto space, it lends itself to chasing performance. And so that's where bubbles start to pick up. And I think that's, outside of commodities and value, there's pretty much, even the bond market in many regards are, some of the credit sectors are in kind of bubble-ish territories because they're stretched versus intrinsic value. They're not really at a fair value. And that happens, it's not unusual, but there's usually some mean reversion that takes place. And when it happens at a point like this, where everyone thinks we'll never see a correction ever again, if the Fed has our back, if that does not happen that way, then it's going to be a rude awakening.
Oh yeah, it begs the "this time it's different" argument, but we'll save that one. George, you're hyper prevalent on FinTwit. We've talked about it a bit. I'm curious, a little twist here. I mean, how do you use Twitter effectively to kind of filter through the massive amount of noise that's out there and deliver as much value as I'm sure it does?
Yeah, so I think in general, there's, information overload has been something that we've been dealing with for the last 10, 20 years, and it's only just grown in speed ever since. The one thing I found, and this is just my approach, I think everyone has their own techniques and style. The one thing I found very useful, and this is just the way I'm kind of trained to think, and it's just my nature as well, is to really compartmentalize, the various tribes within Twitter, the various, there's, a lot of great content, but there's a lot of it is also noise, and really try to. I know there's people that actually built algorithms for that. I have not gotten to that stage, but I do it just for my own just vantage point of looking in and seeing who I think is saying something unique and creative, or has a specialty. And just periodically really check in and see how their thought process is evolving, how it's triggering other conversations, what information is being brought to the surface because of those conversations. And so in many ways, I I view it, and I ran teams of analysts on Wall Street, and I've trained I don't know, maybe 100 interns over the last 20 years. I don't know, don't quote me, but I've spent a lot of time working with very smart people and trying to maximize and learn from them as well, and to just to really get a better product. And I've employed some of those techniques and some of those that style of compartmentalizing, really narrowing in, seeing who's an expert in what, and then tracking it, taking my own notes, and then synthesizing it into my overall macro thinking. And in many ways, it's actually helped me not have to have a team of like 20, 30 analysts, because if you know how to pick and choose who's smart and actually doing great work, it's almost like you've outsourced an analyst group. And I say that
it's so true.
I say that a little bit, but it's true. It's a network effect, right? Ultimately, it comes down to the network effect. But you have to be a good orchestrator, and you have to. Not that I'm like the only one that knows how to do this, but I think if you've done either research in some capacity in your life, or you've learned the skills and the tools that are needed to do that, and then you see something like a treasure trove like Twitter or any of these financial mediums, you can just basically supplant and incorporate and really get an even better insight into what you were either looking into or were not, you were overlooking. It's really amazing. So I'm actually, this is my first year and a half on Twitter. Before I was just more of a casual observer, but this, I actually been very active, and I've also learned a lot too. So it's been a great experience, and it's really helped me, just improve my process.
Yeah. Do you have any tools or softwares that you use to help you do this a little bit more effectively?
I'm old school, so I'm still just scanning through and reading, and then the only tools that I really would use or consider them tools are just saving articles, but indexing articles by names, and basically I'm creating like a card catalog system within my own computer through Evernote and things like that, where just keeping track of ideas and then being able to search them and then have it indexed so that you don't lose your train of thought or what you're working on, saving certain bookmarks, whatever. But yeah, it's really old school, block and tackle, actually hands-on going through all of those tweets. I haven't yet gotten to the point where I've industrialized it yet. I'm looking into it, but yeah, it's the way I think anyway.
Yeah, I think that's the unfortunate reality. I mean, they have the smartest people in the world trying to get you to spend more time searching and scrolling, and these things. These tools would eliminate that. They don't exist for a reason. But George, I really appreciate you coming on today. We're bumping up against the time. To leave my listeners, where would you like to send them? Where can they find out about you, your writings? Where do you want to send them?
Yeah, no, I think for now, just thebondstrategist.com. It's still in its early stages. It's really a place where if you can get a hold of me, you can email me, ask to get added to my distribution list, whatever is your fancy. And of course, I'm pretty active on Twitter, so the @bondstrategist handle is me, and so just look me up there and feel free to follow and go and feel free to ask questions, because I don't answer all of them. It's impossible, but I do find it's important to have an open dialogue on this topics around Fed macro and bonds, because I don't think enough of it's covered properly, and hopefully I'm helping out the greater FinTwit universe.
I'll link up all of those things on the show notes. It's been a real pleasure, George. Thanks for coming on today.
Oh, thanks for having me, Ben. It was a pleasure as well.
Absolutely.
There you go. First off, thank you very much for listening all the way through. I hope you got a lot of value out of that conversation. As always, you can find show notes, links, and more at altassetallocation.com. Please share this with anyone you think might be interested and derive any value from this conversation. And as always, you can reach out to me for any feedback or questions. Please give the video a like, or even better, subscribe on YouTube or your podcast player of choice. This really helps others find the podcast or the video as well. Thanks a lot. Hope everybody has a fantastic day, and stay safe out there and invest wisely. Cheers. 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 Cheers.